Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome back to the channel. Today we are talking about why you should avoid risky zero-collateral lending apps. These platforms promise high returns, but they also carry serious risks to your hard-earned money. If you want to learn how to protect your savings and make smarter financial decisions, then keep watching. The idea of earning 15% or 20% interest on your extra cash sounds like a dream. Many people today look for ways to beat inflation and grow their savings faster than a bank allows. Peer-to-peer P2P lending apps often promise these high returns by connecting you directly with borrowers. Some of these platforms offer zero-collateral loans, which means the borrower doesn't have to pledge an asset like a car or a house. While this setup makes borrowing easy, it creates a massive amount of risk for you as the investor. You might think you're just helping someone out while making a profit. However, the reality is much more complicated. Traditional banks demand collateral because it gives the lender leverage if things go wrong. When you remove that safety net, you're essentially gambling on a stranger's word. If the borrower decides to stop paying, you've very few options to get your money back. In many cases, the high interest rates are just a distraction from the fact that your principal investment is constantly in danger. It's tempting to chase big numbers, but protecting your hard-earned money should always come first. These apps often hide the true level of risk behind sleek interfaces and bold marketing. Before you hit the invest button, you need to understand how these systems actually work. Losing your entire investment is a high price to pay for a few extra percentage points of interest. The hidden dangers of lending money without security. Most people understand that lending money carries some level of risk. In a standard setup, a bank holds a lien on a property or a vehicle. If the borrower defaults, the bank sells the asset to cover the loss. Zero-collateral lending apps completely skip this step. Because there is no physical asset involved, you're participating in unsecured lending. This means your only protection is a digital contract that can be very difficult to enforce in the real world. When you use these apps, you're usually lending to individuals who couldn't get a loan at a traditional bank. Banks have strict rules because they want to ensure they get paid back. If a person is rejected by a bank, it's often because their financial history shows they're a high-risk borrower. By investing in these apps, you're taking on the risks that professional bankers deem too high to touch. Lending without security also means you're last in line if the borrower goes bankrupt. If someone owes money to the government, a mortgage company, and then your P2P app, guess who gets paid last? You'll likely receive nothing because there are no assets to liquidate for your benefit. In short, you're taking on institutional-level risks without having the professional tools to manage them. That's it for part 1. Now you understand the dangers of zero-collateral lending apps and why high returns usually mean higher risks. But we are just getting started. In part 2, we will talk more about warning signs, how to protect your money, and safer ways to grow your savings. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.